everyone, welcome back to Corporate Decoder. Today we're diving into a report from the Delaware Group Tax-Free Fund. Get ready to see how tax-free really works and whether these funds are actually a free ride or if there are some hidden fees and turns along the way. Spoiler alert, nothing is ever truly free. This isn't a company selling products, but rather a fund managing money. So we're looking at how well they're handling other people's investments. It covers the 6 months leading up to late February of this year. The main question is, did they make money and how? What we're decoding is essentially a shareholder report. It's designed to give investors a peek under the hood. There's all sorts of details here from fund names to expenses and even holdings, but we'll stick to the stuff that actually matters. Alright, so the first thing you usually see is a letter to the shareholders. This time it doesn't seem to be included, so let's get right into it and see what this fund actually costs to use. Here's where the rubber meets the road. Costs, they break it down based on a hypothetical $10,000 investment. For their Class A shares, it would cost you $40 for every $10,000 invested. Now, on the surface, this seems pretty low, but we'll dig a little deeper and see if that's actually true. That converts to an expense ratio or percentage of 0.81%. Class C will be more expensive at $77 for every $10,000 invested. Next up are some fund statistics, a quick rundown of what the fund holds. They say the total net assets, what the fund is actually worth, is over $1 billion, about $1.2 billion to be exact. Now, of that big chunk of change, they paid out about $2.5 million in advisory fees. You really got to pay to play. The portfolio turnover rate is 8%, meaning they're not swapping out investments super frequently. The investment mix is interesting. They have their holdings broken down into different sectors. The biggest chunk is in special tax revenue bonds, followed closely by industrial development revenue, pollution control revenue bonds. Let's just call that regular old industry bonds. What's interesting is where they're investing geographically. A significant amount is in California and Puerto Rico at 13% and New York at 10%. This kind of geographical concentration can be risky because if those places see some sort of economic hit, the fund could be hit hard too. Now, this filing actually has similar reports for a couple of other funds. Let's see if they are holding similar allocations. This time for Macquarie Tax-Free USA Fund Class A, the hypothetical $10,000 investment will yield similar expenses, $38, but it's for the fund that we previously saw was highly invested in California and Puerto Rico. The net assets is roughly the same, slightly above 1.2 B, and the same turnover rate of 8%. Interestingly, the top investment at nearly 20% is industrial development revenue, pollution control revenue bonds. Looking at geographical distribution, the top investment is now New York, so the investment profile is actually very different than the first fund we saw. Finally, the report finishes with a Macquarie Tax-Free USA Intermediate Fund with, yet again, a very similar expense rate and a 13% turnover rate instead. This one's top geographical investment is also New York. After all that data, there are usual legal formalities to be aware of for shareholders, as well as directions about how to get more information. Now, scrolling all the way down to the full list of investments from Macquarie, it's mostly bonds in various municipalities. Nothing shady, but you got to know what you're holding. There's even the usual "we check the books and everything looks okay" statement from the top dogs, so we can assume nothing too crazy is happening. So what's the story here? Macquarie is offering tax-free funds that mostly invest in municipal bonds. Their cost structure is a bit opaque, making it difficult for regular investors to assess. Also, while they claim to be diversified, they really aren't, with many funds concentrated in specific states like California, Puerto Rico, and New York. If those areas have problems, so will your investments. As for areas of strength, these funds are performing decently. Also, they provide income that's exempt from federal tax. A big advantage for some people there's also real cause for weakness. The funds have a high geographic concentration and some of their bonds appear risky, especially ones coming out of Puerto Rico. I would advise you carefully consider if this is a good investment vehicle for you and consult a financial advisor. If you are not comfortable evaluating this information yourself, all in all, this is a fairly standard filing that seems to be trying to make a case for stability during uncertain times. As always, it's important to look deeper and not just take everything at face value. Don't forget to weigh the pros and cons based on your own risk tolerance and financial goals. Thanks for watching. Make sure you leave a like, comment, and subscribe for more Corporate Decoder videos.